Welcome to Magnolia Bank Academy. My name is Dan Mason, and in this video, we're going to be discussing discount points, what they are, how much they are, how they work, and probably most importantly of all, how to use them to your advantage. So I've been helping homeowners with their mortgages for over 2 decades now, and almost every conversation I have starts with the same question. What's your interest rate? How often, you ask? Every time. That's the most obvious and straightforward question to most people. But if you only get a rate quote and you don't ask about the points, you're missing half the pieces to the puzzle. So when comparing interest rate options, there's 2 main components to take into consideration: the interest rate and the discount points. In this video, we're going to break down what we mean by discount points, commonly referred to as just points, and how to use them to get what you want. So what are points? Points are a fee that you pay to get a lower interest rate over the life of the loan. So think about it like this. Points are basically prepaying interest up front. So you pay less in interest on a monthly basis. The more points you pay, then the lower the interest rate. Makes sense, right? If you give the lender some money up front, then the lender will agree to charge you less on a monthly basis in the form of interest. So now you can see why asking the question, what's your rate, isn't enough. A low rate with a significant amount of points is not an apples to apples comparison to a rate quote with 0 points. There's nuance there, and every homeowner should understand points and how to use them to your advantage. So now that you know what points are, you're probably wondering how much they are. Come on, Dan, show me the money. So 1 point is equal to 1% of the loan amount. So for example, on a $300,000 loan, 1 point is $3,000. Now, a common misconception is that paying 1 point drops the interest rate 1%. Unfortunately, it's not a 1-to-1 ratio. Generally speaking, 1 point lowers the rate about 0.25%. And the deeper you buy it down, the more expensive it gets. So really, is it worth it to pay points? Well, that depends on your time horizon. What we like to do is to calculate the break-even point. So let me show you how this works. Here's a real-world break-even analysis that we prepared for somebody who was looking to pull some cash out of their property to do a little remodeling. So they wanted to explore all of their different options with this new loan amount. So we prepared this break-even analysis to give them a comparison. So as you can see here, they wanted a loan amount of $560,000. And so we prepared this quote for them. By the way, please don't read too much into these interest rates. Interest rates change every single day. This is just listed here for illustrative purposes. So in this hypothetical example, at a 6.25% interest rate came with a 0 point cost. This means they were not paying any money in fees to buy down the interest rate. So as you can see, a $560,000 loan at 6.25 comes with a monthly payment of $34.48. Now, if they wanted to, they could pay a small amount of points. They pay 0.45 points on this $560,000 loan amount. So we take $560,000 times 0.45 points. That gives us a dollar amount of $2,520. That will lower their monthly payments by $45 to $34.02 per month. So is that worth it? Well, we figure that out with this break even here on the end. We simply take the number of points they're paying, 2,520, divide that by the $45 a month savings. That tells you that it takes 55 months or about 4.5 years just to break even, just to get your $2,500 back and then be net $45 a month ahead of the game. That's a long time. That's almost 5 years just to get your money back. Now, what's interesting is that it's never linear. There's always a sweet spot. And the one that jumps out to me is this one right here. So at a 5.75% interest rate, you can see that came with a 1.25 point cost. Again, $560,000 times 1.25 points, $7,000 in fees. But you can see it dropped their payments by $180 a month from $34.48 all the way down to $32.68. So again, we take that $7,000 in points, divide it by the payment reduction, that gives you a break even of 38 months or a little over 3 years. That's a sweet spot. That's where you get the most bang for your buck. You pay as little points as possible to get the most possible reduction in payment as possible. Now, in this scenario, this was their forever home. They were doing some remodeling because these people wanted to stay put. So it was worth it to them to pay the points to go down to a 5.75% interest rate, and knowing that they would keep this loan for at least 38 months and then be net $180 a month for the remaining term of the loan. Now, let's say you had a different scenario. Let's say that you were pulling this cash out to do some remodeling because you wanted to sell the house 12 months from now. Well, in that case, all of these options here take you 3 to 5 years just to get your money back. You would not pay the points in that scenario. You would go with the 0 points option because you just aren't going to have this loan long enough to make your money back and be net ahead by buying down the interest rate. So I hope that makes sense to you. So is it worth it to pay points? And the simple answer is it depends. Every homeowner's situation is unique. So visit us at MBLending.mortgage and we'll prepare a custom break-even analysis based on your time horizons to see if paying point makes sense for you. So once again, my name's Dan Mason, and I look forward to showing you what we mean when we say here at Magnolia Bank, we have a personal way.